The S&P has been mostly flattish since its record closed nearly 2 weeks ago, but it still gained 27% this year. So can it keep going? My next guest says yes. He has the third highest price target on the street in 2025 at $7K flat. Joining me on set is Binky Chadha. He's the chief market strategist at Deutsche Bank. So Wells went to 7,007. This is like the Price is Right. I'd love to know what the difference is or how they get to that granularity. But broadly speaking, why do you think stocks can keep rising with valuations where they are and so forth?
Sure. What I would say, at the sort of highest above ground level perspective, equities are really about the business cycle. I would say the business cycle is going really, really strong. If you take one very simple measure of the economic context, so it's low unemployment, but also at the same time, very strong GDP growth. We've averaged almost 3% for 2 years now, and unemployment still in the vicinity of 4%. And you look back at history, you will see that this almost never happens. It's happened 6% of the time, and I think the times that it happened previously is very telling. So the first time was for 4 years, from 1965 to 1969. And for those of us who aren't well versed in U.S. American history, that was, what many historians call basically economic nirvana. You have 3 to 4% GDP growth, 3 to 4% real productivity growth. You have basically inflation falling, 3 to 4% real wage growth, reflecting the productivity increases. And the second time it happened is in the 90s. But on both times, equities did extremely well.
But that's what I was. So in the 1960s, we all think of that period as one of dramatic social upheaval. So I think the economics gets overlooked. But
exactly.
So the market did quite well during that period of time.
It did extremely well for a long time.
Because the previous analogies many people are referencing are the stretches in the 90s and even in the 1920s. Where we've had years of back-to-back 20% gains. Both of those ended up with spectacular crashes. So your analogy to the 60s maybe gives us some hope, does it, that we can kind of experience these kind of gains without there being a hangover effect?
So the way I think about it is, there's a cycle, and we are at a certain stage in the cycle where I would argue a number of factors, sort of coming together. So for now, I would say the cycle continues. I would say the cycle stays basically pretty strong. I mean, another very simple way of thinking about things, there's very little doubt that basically equities have risen very, very strongly. We are up, basically for 2 years in a row in a very tight trend channel. It's going up at 24% a year. So it will obviously slow or break at some point. But I would argue, and you're absolutely right. This is not a common or frequent occurrence. It's only happened basically in the last 100 years, 4 times before, where you have sort of 2 back-to-back 20% years. But again, that's really sort of a calendar take. The way I would put it is, in terms of peak to trough declines or trough to, next peak recovery, the magnitudes are not unusual. What is unusual is basically the duration and the steadiness with which it's happened. And it really suggests partly that a lot of the rally had something to do with what was not priced in. Obviously, if you look back at the last 2 years, that's very clear what that was. The market was looking for and positioning for a recession. We didn't get a recession, of course, so that gives you positive data surprises for a while. But what I would argue is, as I was just arguing, the economic context is very, very strong. If you think about unemployment and growth at the same time. And the two things together, a primary driver of volatility, argues basically for volatility being low, and argues for strong risk appetite, and risk appetite is strong.
So two questions.